Well, hello. It's Bruce White. I'm host of Straight Talk Wealth Radio, also podcast, TV, video, whatever. Um, we are doing part 2 today on a show that we did last week where we're exploring stagflation. Last week, I did a condensed version of the training that I'd done for my clients on stagflation. Why does this matter? Well, first of all, it matters because if you look at our motto, our watchword of this show, it's Straight Talk Wealth Radio because things are going to change. So I don't know if our parents went through this, but our parents through the 50s and 60s, there were some changes, but there were long-term growth in the United States. And man, when they were getting into work in the United States, Europe was devastated and we were the powerhouse. We are going through so much change. And you personally, if you're my audience, you're going through change because you're in your 50s, 60s, or 70s. When you are accumulating money and you're just growing it all the time, there's not much to be concerned about. But when you get older, the game shifts from just up 10%, up 7%, down 5%. You just put money away and you let it grow long term. But that game changes when you get older. And when you get close to retirement, you have to now preserve what you made, because if you lose 40% of it in a crash or something like that, or whatever it might be, that's going to change your retirement date. But the other things that change are that you're going from accumulating to distributing it. You now have this formula of like, okay, you've got 30 years, you've built your money. Now you've got 20 to 30 years of spending it. And of course you want to spend it for the greatest that you can and still know that you won't run out. You want to live the best life. You want to spend with certainty and comfort. But how do you know what the future looks like? How do you know what your returns are going to be? I mean, all of this, should you try to target $500,000 left the day that you die? $10? $1 million? All these things really are game changers. And if you throw into that change, and by the way, the other change is that your health changes. And yes, you've got income sources and you've got Medicare and all that, but man, Medicare doesn't cover long-term care. And one of these days, I'm going to do a whole episode story on my mother who needed long-term care for 14 freaking years. And my dad had no coverage for that. My dad had passed away right early on in her period of needing care. So she needed care for 14 years. It cost my dad's estate, at least $1.5 million. And if he didn't have that in his estate, me and my brothers would have all collapsed in. Our wives would have been caring for my mom. It would have been a fiasco. So there's many, many things that begin to change when you get to this age that the boomer generation is at. And one of the things that we track very closely in our practice here is that the economic environment is changing. Who cares if you're 30 or 40, what it looks like? But when you're late 50s, 60s, 70s, man, things go the wrong way. It matters and it changed your life, and it might change your life for the rest of your retirement. So that's what we're looking at. So that for that reason, I dove in last week to the story of stagflation. Stagflation is a whipsaw between inflation and deflation. It is the current economic model that we are in the middle of. And if you didn't see that episode, you want to get the basic information on stagflation, then go back and watch that one. Hopefully it's posted in the same place that you're seeing this. But today I want to move on and I want to review the delayed. First, I wanted to view in the news headlines the whipsaw of how stagflation generates, is started with inflation, but generates deflation. It starts with a heated up economy that the Fed then tries to drive down, which eventually winds up in a deflated economy, stocks falling, real estate prices falling. And it, like I say, it's a whipsaw. How do you invest in that? If you don't invest your money and you let it sit on the sideline, inflation's going to eat it up. You can't not be invested, but you're investing into an economy that the Fed's trying to crush. So we're going to go out and get a couple news stories on this that I'm going to pick up in the second half of my PowerPoint that I started last week. Last week, we talked about the basics of inflation. I'll quickly go through a couple things on the basics. And then I want to talk to you about how we navigate this, some of the strategies we're using. They're not the only strategies, but they're well worth considering as a solution. And then we'll wrap it up because you talk too much, Bruce. I know. So anyway, here we go. We're going to take a quick look at, first of all, Ray Dalio. Who is Ray Dalio? Ray Dalio is an American billionaire investor and hedge fund manager who has served as the co-investment chief officer of the world's largest hedge fund, Bridgewater Associates, since 1985. World's largest hedge fund. So what does he think is going to happen in the coming year, 2024? Let's check in with Ray here.
For next year, are you optimistic about the global economy or pessimistic?
Pessimistic.
Pessimistic.
Pessimistic about it. Look, you have a political, you have a monetary, you have a conflict type of environment. At the same time, you have the greatest inventiveness. We talk about this fabulous technology development that has so much potential to produce wonderful things, and then it could be a problem. So if you take the time horizon, the monetary policies that we're going to see and so on will have greater effects on the world. And you look at the world gaps, so it's difficult to be optimistic on that. And I think that now the real issue, I think, is how we deal with each other. Okay, it was said earlier very well. Peace. If we can keep a peace, if we can have a healthy, competitive environment without having a war with each other, we will be in good shape and we will make adaptations.
Okay, that's a great 10,000 foot view. That's a great 10,000 foot view. Thank you. I want to move to another video here that is a little bit more granular look at where it's going. And this is good because this video is a debate, and I'll try to moderate over the top of it in terms of either I'll clip any terms that might be misunderstood, and also identify who's doing this because I brought the video up. I forget whose video it is. I always try to acknowledge that on YouTube. But I want to look at a little more granular look at whether we've topped out on inflation, the reasons, like during this time, it's taken enough time now that many companies have cleaned up their balance sheet. They're not deep in debt. So as debt starts to ratchet up, there's this idea that some companies have already ducked that bullet and some aren't. And there's a little bit of debate going on after this. And I just did this as a balanced look because the story here, I want you to understand in stagflation is it whipsaws inflation and deflation. You can't not be invested because inflation is going to eat your money up. But are you investing into the next recession just to lose your money in the stock market? That's what we're exploring. This next video has a good balanced look at it. So let's explore this, and I might talk over the top of it. We'll see.
Bring in our headliner now. Just ranked #1 in both portfolio strategy and quantitative research this year by Institutional Investor. Inducted into their All-America Hall of Fame list, he is Dubravko Lakos. He's the Chief Global Equity Strategist at J.P. Morgan.
J.P. Morgan, Chief Global Equity Strategist.
Thanks for having me. All right, so by virtue of these accolades, your point of view matters to a lot of people. You heard Jim suggest that the economy is doing much better than people think it is. You're one of the doubters, some respects, about where the economy's going. So let's match this up.
Yeah, absolutely. I am one of the doubters. I've been a doubter even the last time I was here in the set when the market was higher. So for us, macro is really like the big headwind that markets are facing. Higher for longer, cost of capital being elevated is something that we've been talking about since February. Liquidity is getting sucked out of the system as well, which I think is generally a pretty big and important headwind.
Okay, let's just take those two things. Cost of capital and liquidity. So when you're running an economy and businesses need to borrow to pay employees before the money comes in, if you're a small businessman, that stretch between when you earn your money and when it arrives and how you're going to keep people paid, that is liquidity. And cost of capital is how do you go get more capital to keep your money going if it's a much higher cost to get it. These are two things that are hurting, will hurt, and come home to roost in the economy is what he's talking about.
Obviously, there's geopolitics that we can talk about, but that's also an additional tail risk that's very hard to sort of handicap. Fundamentals, to your point, I agree. I think I see them slowing. They're just not collapsing. And the word that I would use on the fundamental side is we're seeing increasing bifurcation on the fundamental side.
It sounds like the crux of your...
Hey, Tony, you got a dictionary? What's bifurcation mean? I should look it up here. Let's define a word, bifurcation. Hey, Siri, what does bifurcation mean? Oh, I have it turned off. All right. The division of something into two branches. Oh. Yep. Two branches or parts. So what's he talking about bifurcation here? I want to just break this down for a minute, see if we can get what he's saying is bifurcating or breaking.
On the fundamental side. It sounds like they're just not collapsing.
The whipsaw.
And the word that I would use on the fundamental side is we're seeing increasing bifurcation on the fundamental side. It sounds like...
Wow, that's kind of what I was talking about. Inflation, deflation. So you've got things heading in two directions is basically what he's talking about. And it's sort of a split scene in terms of trying to analyze where we're going. The circumstances are bifurcating. And you're going to hear that because the rest of this debate is about two different viewpoints about the market. It's kind of the bifurcation he's talking about, I believe.
The crux of your argument is built around the idea that the lag effects are going to be more dramatically felt than people realize today. Fair?
Yes, very fair. I think there's just a lagged effect, and this time around in this cycle, the lag simply may be longer than what we're accustomed to sort of seeing in the prior cycles because of the unprecedented, injection that we got during COVID, and because of a relatively healthy starting point for things like balance sheets.
Jimmy, I want you to respond, and then I want Steph to also, because you guys have a more sanguine view on where.
Okay, real quick. Balance sheets, in case you don't know. Balance sheet is basically assets versus liabilities. So he is talking about one counter pressure, which is the increased interest rates, cost of capital, lack of liquidity that's going to be driven by the high cost of money now. And then balance sheets are companies have been working, this is kind of the bifurcation of the two looks. Companies have been working to get rid of debt before it explodes. So where they've had money, they've all been trying to clean their books up, get debt off the books. And that was where he's talking about balance sheets. Balance sheets have improved in some sectors, not in others. And that's where the rest of this conversation will go.
We are relative to Dubrovko and some of his colleagues over at JPM.
Okay, Dubrovko, always good to see you. Thank you. Look, for the last year and a half, I think you'll agree, the economy's done a lot better than expected. And let's just chalk that up to the lagged effects being a lot more lagged than any of us expected. All right, let's just say I give you that, and we can disagree about the path going forward. But these companies that during this extremely long lag time have out-earned, and cleaned up their balance sheet, doesn't that actually perversely extend the lag further from the point of view of they have less debt to refinance, right? I mean, that's what we're worried about, at least at the corporate side, is they're going to have to refinance at these much higher rates, except now there's a lot less debt because they've paid down a lot with all the extra cash flow. Is that right?
Yeah, I think that's broadly right, but I think that's just one part of the picture. I think for the S&P 500, for the large cap complex, balance sheets are in a pretty good spot. Rates going higher is a headwind, but just a gradual headwind. The problem is that
he's talking about large cap part of the S&P 500. He's talking about the larger companies that cleaned up balance sheets.
I think as you move down the cap spectrum, you look at mid cap, small cap, the entire private sector. There's a more significant portion of that's variable, that's more sensitive, if you will. Balance sheet is more sensitive to cost of capital, and everything that's happened so far during this call, that increasing headwind from cost of capital, has happened under a relatively healthy top-line demand type scenario, where pricing power has been strong and where a lot of corporates have been basically growing not organically, but just through price.
Dubrovko, forgive me, why aren't companies laying off people?
I think that's the lagged effect. I think that's a risk that we're facing in 2024. I'll give you one statistic. S&P 500, if I'm not mistaken, which is right, the Fortress balance sheet employs only, I believe, 12, 13 million people. If you look at mid-cap, small-cap, private sector, you're looking closer to 60, 70 million. And
All right, so he's now parsing this and he's saying, yes, of course, big companies made profits and clean up their balance sheet, but way more people are employed in the mid-cap and lower sectors, which he thinks are going to take a hit. So he's now looking at how many people might be unstable at being able to stay employed, and it affects far more people, and those people have not cleaned up their balance sheets as much as the super big companies, is what he's saying. True or not? Stagflation is a whipsaw between inflation and deflation, and that is why you're seeing this sort of bifurcation of opinion.
that's the area that's more vulnerable to the macro head.
That sort of bear market already, though. Like, what if a lot of what you're saying is true and priced in? Where the Russell is not the S&P.
I think things are definitely getting priced in, but to me, that's a worrying sign. To me, that's a sign that the market is telling you things are slowing down. We're hanging on to the Magnificent 7, Magnificent 11. All the returns this year are coming from basically 7 stocks. So that's telling us. So I think, yeah, we better hope that the NVIDIAs of the world keep just really rolling in very, very strong numbers. The second that goes, what do you hang on to?
Hey, so here's the thing. So what does your advisor say? What kind of conversation do you have with your advisor about this? Like, is your viewpoint, I know I'm 65, I know I'm counting on this money, but if the market falls, it falls. There's nothing I can do about it. Or it's only a loss on paper. Or, you can't control these things. BS. Okay. Our model is different, and I'll talk more about our model here in a minute, but the point is these things do matter. And if you want to be apathetic about these things, we're probably not the right people that you'd want to work with. But we look at this very carefully, and we take risk differently for older people than we do younger people. Most of our clients are older. We don't care so much for younger guys. We have strategies for them that are more about reducing future taxes and the discipline of keep putting money away. But older people, your job, once you're done accumulating, is to preserve what you've got and then distribute what you've got. And it's a different game. And so these changes matter. And again, if I haven't said it once, I'll say it again. Straight Talk Wealth, because things are going to change. So I want to take you to a PowerPoint presentation that we did. I'm starting this halfway in right now on stagflation. We went into the causes of stagflation a little earlier, and I'm starting this halfway in. So currency has been so heated up because of loose money that the Fed now sees that it's heated up and it's on fire. And the value of your dollar is literally burning up as prices increase and increase. And all the loose money that is finally now hitting us is making your money worth about nothing. So what tool does the Fed, the Federal Reserve, Mr. Jerome Powell and his other bankers have to attack this with? What they're going to do is they're going to keep raising interest rates until the economy cools down. They're trying to take some of that money out of circulation, make it less money circulating, which drives the economy back down. So they're going to keep interest rates, raising interest rate until the economy cools down. So here's how it looks step by step. This is a little review from last week. First thing is they're going to raise interest rates, which dries up the easy money. Secondly, that will slow inflation. That is just starting to ebb now. But once inflation has been slowed, that's just the first step. The second thing that happens, and this is where it's all about soft landing, hard landing, the amount of work that it takes, the amount of counter effort and wet water poured on the economy to slow inflation, eventually goes into the economy and starts to weaken the whole economy. Hopefully, it'll be too late not to, I guess. My note was on that is hopefully he'll pull it back before it slows the whole economy, but he slowed inflation. But I don't even know if you can have one and not the other. I don't believe you can. I don't think you can slow inflation unless you slow the economy. Once you slow the economy, now you're talking about a recession. You're talking about a pullback. This is the deflationary aspect. Housing prices start to come down. The value of your home and your equity starts to come down. The stock market realizes, particularly in this small cap and mid cap areas he was talking about, which so many more people are employed in, that smaller companies have to start letting people go. They contract. More unemployment, businesses shrink, unemployment looms. So these are the things that will happen on the backside of the cycle. This is what we're watching. We haven't gotten there yet. And that's the whole dilemma right now at the end of 2023 is whether we slowed inflation or are getting a soft landing or whether the latent or delayed effects are still coming. Now, once the cooling comes, there's now less money in circulation. You have a slower economy and unemployment, and you have price de-inflation, which just means the slowing of inflation, or you actually have deflation, which is your stocks and your home and your business are less in value than they were before. Now, there's a theory, this is Bloomberg, I did this a while ago, cash is the only winner in the market gripped by stagflation fears. It says investors are eschewing almost everything except cash in the sell-off. Now, we had, this was back in 22 when it started, when I really put this first together. And I want to acknowledge that we had, once the market realized the Fed was done with hikes, in November of 23, the market took off. The market had a great November, at least for the month. That's kind of been priced in, as they call, and now it's waiting to see whether it's getting worse, whether inflation's been under control, is it going to hit and cause a recession later, and that is your delayed effect. And that is also what I say it's a whipsaw. The markets also whipsaw during these times. If they get some good news, they go up. But he's already kind of put these time bombs into the economy. So he slowed down. Good news, he's not going to raise rates anymore. But that delayed effect of, well, now companies are laying people off. They had a hard time. And interest rates are so high, he waited too long to bring them back down. Oh my God. It's like they start to fall and the market falls again back. So what this article is saying is just, in a situation like that, stay in cash. But here's the question that I would pose, which is, how do you keep your cash safe from being eaten by inflation while you wait for markets to come back alive after the recession? Where do you keep cash? You can't have it earning nothing. It's got to be very competitive. So at Straight Talk Wealth, and what we do with our advisors, and if you ever want to reach us, you know how to reach me by email. It's bruce@straighttalkwealth.com, bruce@straighttalkwealth.com. We have you call this number into our office, 888-882-5578, 888-882-5578, because I want to talk here about how we manage differently. And this may pique a little bit of people reaching out to us that want to know more. Traditional risks follows this paradigm. I might lose my money. I need to be willing to lose my money. Oh, well, that's the only way I can make some money. And that is the risk paradigm that we all operate on. We've all been educated on. We have a different paradigm at Straight Talk Wealth. Our paradigm is we're going to eliminate any losses. There will be no losses. We're not going to put money anywhere where it can have a loss. And during a recessionary period, that is incredibly important. But you got to make it grow. Now, worst case scenario, if the markets fall, if things fall apart, you'll be in a preservation mode. You might make nothing. Preservation mode, not mold. You might make nothing. That's possible. We're in preservation mode when markets are falling, and we just make sure that we're not losing in the market. But we always have the option, even if we think the market's going to fall, we can turn around. And this is something I want to talk about at the end of the show. This is the best time. The best thing that has happened because of these high interest rates are our guarantees are higher than they've ever been. They're not 4 and 5% anymore. I'm sorry to tell you. They're 5 to 6 to 8% now. 8% guarantees on a year's worth of money. And you can find that now because the higher interest rates have goosed this certainty level. And the certainty level is in the middle. I will make something, no doubt, if I go with guaranteed interest maybe slightly less than inflation. I would say 8% right now, with inflation flowed down to about 3.5% to 4%, is better than inflation. And right now, because interest rates have so goosed up, we can go get those. That's not going to last forever. I don't think that's frankly going to last more than a few more months, because one of the articles I'm going to go in a minute is that the tide is starting to turn, and there is going to be a softening of interest rates, and then what we can offer comes down. This is the best time, I'm telling you, in 20 years that I've seen our ability to go grab this type of a model and make it perform. So we have the mid model, which is typically 5 to 8% with certainty. And then we can go 6 to 17 to 18% when the markets finally grow back. So you can have the growth. You might make a little or you might make a lot. And that's really the paradigm here. The paradigm of this is you will not lose money. The difference is I might make a little or I might make a lot. And that is a risk. And our clients do worry about that. And we worry about it. But it's a different worry than, am I going to lose money today in the market? All right. I talked about last week that I just threw this in. This is a study of, I kind of want to skip this. We covered this last week. Basically, during the last stagflationary period, I studied it. Now, this is not the last stagflationary period, so I left that out. But the market was up and down. There was a chart we showed us up and down. I'm trying to save time. The market was up and down. This is another up and down period. It went from 1997 to 2009, and it included the tech bubble, and it included the Great Recession. Now, our strategies work like this. If you were just in the market during this 10-year period, you had no growth. The sad news was that during the early part of this, there was actually 66% growth over 3.2 years. It's just that it was lost. Hit the bottom, and then by 2003, it was coming back out. And that point up until the Great Recession was a 70% increase in the market over 4.8 years. So over this 10-year time, the market actually grew by 130%, but not end to end. From growth period, crash to growth period, that represented 136% growth over those two periods. So what we're looking at when we work and this is just a rough model, I pulled these numbers out of my ear, but when you're in the market, you're taking the ups and you're taking the downs, as you see on the left. So you went up to 250,000 from 100,000, but then you fell back down to 150, and then you finally got back up to 250 over a 10-year period. What we do is we do our model here. Now, this one had a minimum guarantee where it went up to 200, didn't go to 250. It was a little less growth, but we locked out the fallback. So now we're staying kind of level at that 200 until the market rises again. But we rise from the 200 that we left at, not from the 150 that it fell at. That's essentially what we're doing with our models. So, okay, I had some numbers in this. Goes to 152. Instead, we wind up at 189. And at the end, because we got a portion of it, we wound up higher in the end after a fall than you would have been taking the fall and trying to come back out of it. All right, so what that means is this. What you need to win during stagflation is this. Don't lose money to shifts in down market when the recession comes. Don't try to guess the turnaround. There may well be a third leg down. So the market will be up and will be down. Unless you're a professional, don't try to time this. And don't lose money because they're in what will be a recession coming. Don't lose money to inflation by sitting on the sidelines. You need both of these. And stay flexible, be able to shift. Strategize year by year. So what we're telling people right now is we're telling them to take the 8%. We can go get you 8% of the year. Take it right now. I don't have any confidence at all that markets will be up by the end of the year. Next year, if it looks like they're going to fall again, even if we can get you 5 or 5.75, which we also have available, I don't know, the 8% is like a deal going on right now this year. That account may recede back to a 5%. But we can do that next year if we think the market's going to go down, or we can shift into the markets. So you want that flexibility. You want to strategize year by year. And this goes back to that model I just showed. These are the places we can go to execute that model. Now, I want to talk about something that's been extremely juiced. It's been juiced up big by these interest rates. it's not for everybody, but there is a particular sector that is running harder now than I've seen in 20 years. And I've looked at this sector closely in 20 years. And that is, I want to talk about why annuities as a sector are suddenly experiencing hyper performance in this climate. So let's see what we got. How the horsepower has increased. Now, you're not seeing the full training. We've talked about in earlier shows. If you want to see this full training, we will get into how interest rates work inside of annuities and how they make money on the upside of the market and not the downside, all of that. I took those slides out. I just down to the essence of what the result is. Annual guaranteed interest rates have greatly increased. We used to see 2% guarantees. And you don't want to be on the upside of the market. You think the markets are going to down. We could guarantee 2%. Now we're seeing 8% at the high end. Commonly seeing 5.5%, but we're seeing 8%. So that these increased interest rates have greatly goosed in the fixed interest accounts of annuities. They've been greatly increased. The cap means we're going to give you the S&P 500, but for a while it was like, it's like this kind of sales talk. We'll give you the upside of the S&P 500, but it's capped at 5%. It's not much of the S&P 500. Those are doubling and tripling now. We're seeing 10%. And that just means that if the S&P goes up, we're going to give you up to 10% and more in other accounts. Some of them are way more. But if it goes down, you don't lose any money. So that's that upper level that we're talking about, where we can put you in indexes that if the index goes down, you want to play the index, you think the market's going to be up, good, we can play it. If it goes down, you won't lose any money. But if it goes up, the limit on what they can give you has greatly increased. The participation in the gains have greatly increased. That's a function of increased interest rates that underlie these products. Spreads have decreased. All right, whatever. I'm sorry to get into something technical. Spread is just how much it has to earn off the bottom before you get the rest. So it used to be, we'll give you everything this index will give you after the first 3% of earnings. Now it's like maybe after 1% of earnings, you get everything. So spreads have decreased. Participation rates, it used to be, we'll give you 50% of the index. I mean, my God, we're seeing some places now on some indexes that are giving 200 and 300 times. Like if the index does 10, you get 20 or 30. Now, usually they're using a little bit of a volatility controlled index. So let's just say if the index does 5, you're going to get 10 to 15 off of that. So those are called participation rates. They have greatly increased in this market. Other innovations. There's multi-year buckets. If you're in for 1 year, it's 180% participation. If you're in for 2 years, it's 220. If you're in for 3, it's just more options have become available. Greater performance for shorter years. There are some that have now gone for, instead of just 10-year, you can only get a 10-year account. Some are down to 5 and 7 that look pretty good. Now, usually 5 and 7 is a little watered down, but in these new era of this high interest rates, there's good growing accounts that are just 5 and you're no longer just stuck with a 10-year annuity if you want to be able to get all your money out and shift. Now, all of them typically have some sort of safety valuable 10% out a year while it's growing. There are ones that are for accumulation, ones for income. But the point is, they even have shorter terms now because of the rates. Here's an example. This is a 5-year account. The 7-year account's a little bit better. Now, this is a 5-year account. I just want to show you a couple things in this. If we can zoom in, Tony, if you're able to, on this 1 year per, well, actually, let's go over here to the left. Fixed account. This has grown even since I printed this. This was in November of 2022. A year later, this was stronger. They're saying in November 2022, because of these increased interest rates, you can get on the left in the fixed account, there's over $100,000, 4.85% guaranteed for the year. Boom, we'll just give that to you. Guess what? That's up to 5.75 now. So that's even grown. They are tipping. I have to tell you, 5.75, I'm sorry I lied, it might be out of touch. Because interest rates, and this is what I gotta stress, if you're interested in this concept, you gotta move fast because interest rates will start to come back down as quick as the Fed can lower them. This company's already sent me a notice. They shaved a little bit off. They shaved about 20 basis points off of this. So it's a little less than it once was. But if interest rates keep heading downward, this deal will not come back of what you're seeing on the screen. However, it went up from this, but those deals are getting shaved now. So this was up to about 5.5% on a 5-year account a year later. And there's another one here I really like. It's called a performance trigger. This has the opportunity to take lousy market performance and give you a great multiple of it. What a performance trigger is, says this: if the S&P 500 is down, you'll get 0. Won't have a loss, you'll get 0. If it's at least 0, we're going to trigger 9.5% in your account. That has moved up to 10.5%, although it may be getting a little shave back down to 10. And so we'll give you 9.5%. If it does 1%, if it's even up 1% on the S&P, we'll give you 9.5. If it's up 3%, we'll give you 9.5. If it's up 7%, we'll give you 9.5. That's called a trigger method. Now, if it's up 11, we'll give you 9.5. So 9.5 is the limit. But I love this strategy if you think the market's going to be lethargic. But guess what? It's going to go away because at some point interest rates will come back down, and then you're not going to be able to capture this. There's another thing here. They'll give you 100% of the S&P 500. This is on the second to the right with a cap of 10.5%. If the S&P goes down, you'll lose nothing. It will be 0, but they'll give you 100%. Now, I personally don't see why anyone would go to that when you get a performance trigger and its cap is 9.5. Maybe you think you can squeeze that last 1% out. That's important. I really wouldn't go with that S&P 500 cap much. I'd go with that performance trigger like any day if I think the market's sluggish. This is available in a 10 and a 7-year account. I deleted the company's name here because I don't want to have to show all the disclosures and disclaimers. Oh, look, I actually had this on I had this already set up. So I don't know if Tony did it already, but there's our things I had this set up. So investing for stagflation. Preservation. I might make nothing only if the markets fail or make nothing. However, I could go and get a guarantee. Now, I'm not showing you the 8% guarantee. That's a secret. You'll have to call us for that. But I do have an annual guarantee of 8% in an outrageous product. It's not for everybody, but it's out there. They called me up and they said, Bruce Whitey, promote. We're doing 8% right now. And the rest of the contract is actually gorgeous too. So this is the low end of what you'd see on guarantees right now. You can go with that, or you can go with, hey, if the markets do well, give me a piece of it, give me a much greater percentage of it than you used to give me in that growth, and I make it 6 to 17 to 18 to 19%. I don't know. So that is how we invest for stagflation. That is how we manage the whipsaw of inflation and deflation. And the process is basically this. Given the potential for even greater market losses, the first thing you want to ask is, what percentage of your investment or savings portfolio do you want to leave at risk versus what percentage you want to have safe? So ask yourself, how much am I willing to lose, and leave it in the market? Leave it in the market. I'm not saying you should pull everything out. I'm not saying you should do any one thing. But if some of it you think you should be keeping safe at this age, then identify that. Alternate way of looking at this is, how much of your portfolio are you comfortable losing before the economy and markets come back? Now, second part of the process, ask yourself, do I believe that the S&P 500 will be positive a year from now? If yes, then you allocate to the trigger method. If no, then just get the annual guaranteed interest and revisit the question a year from now. So here's what we didn't say. I'm not keeping secrets, just there's only so much time, and I've already spent way too much of your time today that we can ask for. You can do there are several other choices in this product lineup and in this asset class of annuities. There's lots of other choices to accomplish the same thing. In other words, there's lots of competitiveness in the industry. There's competitor 5-year accounts, may have competitive features and index potential. There's 1-year accounts. Currently pays 3.3. No, I don't think so. Well, No, 1-year account. So you can have shorter accounts, you can have longer accounts. I have to check with just the strict 1-year account. I gave you a 1-year rate on a 5-year account. There's annuities that generate income. They're less growth oriented. They're more set up for income. Where are we going here? What you need to win. Don't lose money to shifts in down markets when the recession comes. Don't try to guess the turnaround. There could be a third leg down. When you think you're at the bottom of the leg and you're coming back and it's going to climb back up, it may well, you might be right about that. And there could be a third leg down. It's a constant whipsaw. Don't lose money to inflation. By the way, the amount of money that was pressed in this economy with low rates is so historic. We really don't know where we're going to land in terms of how long it will take to deleverage and shake out. So again, stay flexible year to year. And here's what else I want to recommend. Learn more. How did we learn more? One, call me. 888-882-5578. I should have the slide at the end of all of our shows. 888-882-5578 is the best way to reach me directly. You can email me, bruce@straighttalkwealth.com. That's Brucey Boy. No, it's just Bruce at straighttalkwealth.com. Or book your own appointment on my calendar. So if you want to just book an appointment to call, write this one down. Calendly is our booking service. It's how you can see my calendar. Just throw something on it. Calendly.com. That's the name of the service. /Straight Talk Wealth. And you can get a hold of us through any of those methods. Hey, I know this has been an intense couple shows. I know it's been a lot of data, but things are going to change. I think you need to be ready for it. I want you to know how we think things through. The thing that makes us different is we are concerned about these changes. You must be more concerned about them as you get older. We're looking out for you on it. We're looking out here. Let me go back to this slide, by the way. Yep. Get in touch with us. We'll do a retirement roadmap. That is a service we do for free. It's an analysis of who you are and what you should be doing. I don't know what to recommend. There's not one thing everybody should be doing. It's different for different ages and where you are in life and what other assets you have. But we do a free retirement income analysis called a retirement roadmap that looks at where you are now versus where you want to be, how long you want to be there, and the resources you have to get there. And then we can make recommendations in all of this. I hope you found this educational. Please leave comments if we are, email me or leave comments if we've got this posted with the comment box. I want to know if this was valuable to you, if you learned something, and stay tuned because there's so many topics. I've been years off of doing Straight Talk Wealth every week. I could be doing this easily every week for the next year and not run out of topics. So until next week, signing off. Thanks for watching. And remember, things are going to change.